Right. Hello, everyone, and welcome. I'm Daniel Ladd, a business retirement strategist, and I'm excited you joined me today to learn about a powerful wealth building strategy that most financial advisors just don't talk about. Now, before we begin, I'm excited to announce that anybody on the live Zoom will receive a free copy of my Business Retirement Vault book, which normally sells for $49. And I'll post a link below for anybody who wants to buy it. It will be on special for the next couple of days for those who want to buy it. Now, for those who qualify, I'll also be offering a complimentary strategy session to see if this approach might be the right fit for your situation. Now, today we're tackling the consultant's dilemma head on. How to stop choosing between easily accessible cash that barely grows and high growth accounts but barely accessible. Now, I'll be showing you the business retirement vault strategy, which eliminates this forced trade off. Now, before we dive in, I want to make it clear that this presentation isn't about high risk investments or get rich quick schemes. Instead, it's about a systematic approach to building wealth that gives you control, protection, and tax advantages that most traditional financial strategies simply don't offer. Now, let me tell you a little bit about myself. My journey into financial strategy began studying physics at Florida Institute of Technology, and that analytical training has taught me to break down complex problems and find solutions others miss. Now, I approach financial strategies like solving an equation, finding the hidden variables most people overlook. And as a strategist, I've spent years developing those expertise in areas that go well beyond conventional thinking. Now, in 2024 alone, we've helped dozens of clients with the business retirement vault strategy with remarkable results. And what sets my approach apart is my focus on working directly with select clients rather than building a massive following. I deliberately keep my client base small because this strategy requires customization and personal attention. And I'm not selling courses to thousands. I'm working with professionals who meet specific criteria and can truly benefit. Now, this isn't for everyone, and that's by design. And my goal is to help everyone with their financial problems. That's not what I'm trying to do here. It's to provide exceptional results for the right clients who are the perfect fit for our strategies. So my aha moment came when I realized most professionals face an impossible choice. Either save for retirement or keep money liquid for gaps and opportunities. Now, traditional financial planning wasn't designed to solve this challenge. Now, today I'll show you what most professionals do with their money and why those approaches often fall short, and a strategy that delivers both long-term growth and immediate access when you need it. Now, throughout today's presentation, you'll see how our approach delivers what I call the 3 L's of financial freedom: liquidity, leverage, and legacy. Now, 3 elements that most financial strategies force you to choose between. Now, the problem with like traditional wealth building, there's a ton, right? But let's establish our example first. Someone investing $25,000 per year for 10 years, totaling $250,000. This could be any professional serious about building wealth. And let's see how this performs in different vehicles. So let me share a real example that illustrates the problem perfectly. One of our clients, Karen, had been in consulting for over 30 years, and after decades of hard work, she finally landed some high paying contracts and started seeing significant income. Now, like many consultants, she was cautious with her money. She wanted to make sure she had enough liquidity to cover the gaps between contracts and meet payroll for her team, and also, handle the unexpected expenses that come with life. So she did what most seemed right for her. She kept her money in checking and savings accounts. And by the time Karen came to me, she had accumulated hundreds of thousands just sitting in bank accounts. And she thought she was being financially responsible. But in reality, her money was doing virtually nothing for her. With that, she was just getting an average return of just 0.45% at the bank. Think about that. If you have $1 million sitting in savings accounts and you're earning just $4,500 a year in interest, meanwhile inflation's eroding your purchasing power at 3 to 4% annually. Like, Karen was effectively losing money every single year despite her impressive savings. And this is the dilemma so many people face. You work incredibly hard to earn that money during your active contracts, but then the fear of liquidity needs during contract gaps force you to make decisions that sacrifice your long-term financial growth. And the average return in savings accounts is just 0.45%. And if you contribute $250,000 over 10 years, that's about $2,083 per month. And your interest earned is only $5,625 total. That's just $562 per year in growth. And I understand why professionals make this choice. You need that liquidity when contracts end or when opportunities arise, but this approach sacrifices your long-term financial future for short-term access. And Karen's situation was all too common. She was a successful consultant by any measure, but her fear of illiquidity was costing her hundreds of thousands in potential growth. And what she needed wasn't an all or nothing approach, but a strategy that could provide both growth and access. Now, on the other end of the spectrum, many professionals are told to put their money into traditional retirement accounts like 401ks, IRAs, or TSP accounts. And on the surface, they seem like a solid approach. Now, my client, Brian, he's 50 years young, had accumulated about $800,000 in his TSP account. And after a successful military career on paper, he done everything right according to traditional advice. But here's the problem. He's not able to touch that TSP account until he's 59 and a half without facing significant penalties. And think about this. Despite saving diligently for decades, he wants to retire early and enjoy the fruits of his labor, but he's forced to either live off just his pension and limited personal savings until 59 and a half, or take on another job during what should be his retirement years. Or he could pay hefty penalties to access his own money. And this is the fundamental flaw with traditional retirement accounts. And let's look at the numbers here. With an average return of about 7%, which you can see right here, your $250,000 contributed over 10 years will grow to about $360,593. That's about a gain of over $110,000, which sounds impressive, right? But there's a major problem with this picture. It's all before taxes, and you can't access it until retirement without significant penalties. My client Brian's story is just one example of many of the inflexibility built into these accounts. Now, for professionals, this is especially problematic because when a contract ends unexpectedly or an opportunity requires capital and your money is locked away, and accessing it before 59 and a half means a 10% penalty plus ordinary income tax that easily takes 30 to 40% of your hard-earned money. Think about that. Would you be happy with your money being tied up like that? So while traditional retirement accounts seem attractive on the surface, they create serious liquidity traps, and they force you to choose between saving for retirement or having access to your money when you need it. A choice no professional should have to make. Now, here's where the rubber meets the road. Now, following the traditional approach, with that $360,593 in your 401k, IRA, TSP, using the standard 4% withdrawal rule, you'll get about $14,424 a year before tax. Now, after you run a very modest tax rate, that's roughly $12,925 yearly. It's about $1,077 a month. Think about that for a moment. After 10 years of diligently contributing $2,083 per month, your monthly retirement income is only $1,077. It's about half of what you're putting in each month. Have you ever done this math before? Because most have not. And you also face limited control over your money when you need it most. 10% penalties for early withdrawals during contract gaps, required minimum distributions when you reach retirement age, and continued exposure to market volatility. These limitations are especially problematic for those with unpredictable income. Now, there's another serious issue with market-based accounts. It's the devastating impact of market losses. Now, consider this simple example. You start with $10 in the market, and the market has a bad year and drops 50%. How much do you have left? Yeah, you only have $5, right? Now, the next year, things recover. The market went up 50%. How much are you at now? Most think $10. No, you're only at $7.50 because it's 50% from the 5, which is $2.50. This is the mathematical reality that catches many people by surprise. When you lose money in the market, you need a much bigger gain just to recover. And if you lose 20% of your money, you need a 25% gain just to break even. But God forbid you lose 50% of your money, you need 100% gain. The market has to double just for you to get back to zero. And our client, Mary, she had about $150,000 in her investment accounts and worked with a full-time advisor who managed her portfolio. And Mary rarely communicated with her advisor because she always felt like she was with the right person. Now, the real problem was that Mary only looked at the quarterly or monthly statements showing gains, never examining her overall performance. And when we analyzed her portfolio over the past 5 years, we discovered something shocking. She was actually negative 5% overall. And Mary had no idea that the retirement money she was living off of had actually decreased by 5% over 5 years, despite what appeared to be gains in some of her statements. Now, she was focused on the trees while missing the forest. And we all saw this play out in 2008. The market crashed 38.5%, then gained 23.5% in 2009. But investors were still significantly underwater, and many people needed years to recover those losses. And when was the last time you looked at your overall performance? For most of us, this recovery time is especially problematic. If the market crashes during a gap between contracts when you might need access to funds, or you're forced into a terrible choice, either sell at a loss or struggle financially while waiting for a recovery. Now, let's look at a different approach that addresses these unique problems. So here's where things get interesting. What if there was a financial vehicle specifically designed to address the consultant's dilemma? And what if you could participate when the market goes up, but completely avoid the losses when it goes down, while maintaining access to your money during times of need? That's exactly what index accounts offer. Now, an index account is linked to the market, but not directly invested in it. Now, this creates a contractual agreement with two crucial features. First, you'll never lose money due to market performance. That's a contractual guarantee. Second, when the market goes up, your money increases with it. The company's just going to take a little bit off the top for themselves. And unlike traditional investments where you're riding the market roller coaster with no safety rails, index accounts give you protection on the downside while still letting you capture gains. This stability is crucial for those who can't afford to see their accumulated wealth disappear during a market downturn that just happens to coincide with the gap between contracts or retirement. Now, let me show you how this works with a real example many of you remember. In 2000, the dot-com bubble burst, right? And the market dropped 10.1%. Then 2001, down again. And 2002, down again. 3 straight down years. But with an index account, your money stayed right where it was at. 0% each year. No losses. Then in 2003, when the market finally rebounded, it went up 26.4%. And the specific index account gained 11.2%. So when the market drops, your money stays put. When it rises, you capture a portion of those gains. And this is why I tell my clients, zero is your hero. Because never losing money is incredibly powerful for professionals who need both growth and stability. Now consider the 2008 financial crisis, something most of us remember all too well. The market crashed 38.5%, and some lost entire fortunes that year. Do you know someone that happened to? Unfortunately, most of us do. But index accounts, they stayed at 0%, not a penny lost. Then in 2009, when the market began recovering with a 23.5% gain, which was, keep in mind, not enough to get traditional investors back to break even, index accounts captured gains between 8.8% and 17.5%. Now imagine being a professional during that time. While others watch their retirement accounts plummet, those with index accounts maintain their financial foundation, and this provided freedom to be selective about opportunities, negotiate better terms, or even take time off if needed. Now, looking at 20 years historical averages across different indexes, these accounts tell a compelling story. Some index accounts averaged 7.3%. Others performed even better at 8.1 to 10%. One even delivered a 12% average return. And combining these 5 indexes, the average return was 8.88%, achieved with zero downside risk. And your principal is contractually protected. This is the key advantage most financial advisors never discuss. Now, just like anything else, right? These are historical numbers. These aren't guaranteed numbers, right? Previous performance does not dictate future performance. But you might capture slightly less upside in the very best years, but you never have to recover from losses. You're always moving forward, never backwards. Think about how this transforms your financial planning. No more roller coaster. No more watching the news, worry about your portfolio. No more hoping you don't face financial challenges during a market crash. No more feeling like you need to be a financial guru. Instead, you get a steady, predictable growth pattern that creates real financial confidence when your life direction isn't guaranteed. And this is where the business retirement vault strategy delivers all 3 L's of true financial freedom. One is liquidity. You can access your money when you need it without penalties. 2, leverage. Make your money work in multiple places at once through a self-banking strategy. 3, legacy. You can create a wealth that passes to future generations and it's tax-free, which is huge when you start getting to massive amounts of generational wealth. Now, while traditional approaches force you to sacrifice at least one of these critical elements, the BRV strategy integrates all 3 simultaneously. So let's talk about the business retirement vault strategy. And this is where everything we discussed comes together to create an ideal solution for professionals. Now, the BRV isn't just a financial product. It's a comprehensive wealth building system. At its core is a specifically designed, max-funded, index universal life policy, but the complete strategy encompasses asset integration, tax optimization, and legacy planning tailored specifically to your situation. Now, this strategic approach unlocks powerful advantages from the IRS Tax Code 101A, creating 3 game-changing benefits. First, your money grows completely tax-free. No taxes on the gains, period. For consultants and professionals who are already paying significant self-employment tax, this tax advantage is substantial. Second, you can access your money without triggering tax events. This is crucial during those inevitable gaps between contracts or when you need the capital for your life or business. And third, the death benefit passes to your heirs tax-free, creating a lasting legacy, something to leave behind. But the BRV strategy goes well beyond just tax advantages. You get the zero loss guaranteed protection, growth potential from index-linked returns, complete liquidity once funded, and you get total control over your money. Now, and you get the efficient wealth transfer through strategic structuring. Now, what makes BRV completely different from typical financial approaches is our holistic methodology. We analyze your entire financial picture, and we integrate all the components from asset positioning to trust structure to cash flow management. This comprehensive approach allows you to build accessible wealth and create tax-free income streams in years, not decades. Now, this creates a financial foundation that remains stable regardless of income variability and providing both long-term growth and immediate accessibility. And we can even integrate your existing retirement accounts and other assets into this strategy, ensuring your money is working optimally while maintaining the liquidity professionals require. Now, let me show you a real-world example that really brings this to life. Now, here's a case study for a 50-year-old who contributed $25,000 a year for 10 years. That's a total of $250,000, just like the numbers we've been talking about this entire time. The policy is designed to credit at 6.55%, which is actually conservative compared to the 8.88% historical average we just saw. Now, let's look at what happens. After 10 years, they built over $265,000 in cash value. Solid foundation that remains completely accessible. Now, at age 62, they can take $29,052 in tax-free income every single year, providing stable income regardless of workload. And over their lifetime, that adds up to a potential of $1.7 million in tax-free income. And while taking that income, the cash value doesn't deplete. It actually grows to $508,000 by age 70. Now, let's break this down year by year. So by year 10, age 60, they got $265,000 cash value. Though they're not taking income yet, keep that in mind. They take it at 62. But by year 20, their cash value has grown to $508,000 while they were taking the $29,000 annually. And by year 40, their cash value increased to $2.2 million while still taking the same $29,000 every year. This creates something that traditional financial vehicles can't. Predictable, tax-free income that isn't dependent on having active work, plus access to capital during your working years. Think about what this means. $250,000 contributed over 10 years generates nearly $30,000 annually tax-free income for decades, while the cash value continues to grow instead of depleting. That's the power of becoming your own bank. Now, I want to share what I consider the most powerful feature of the BRV strategy, the concept of becoming your own bank. And this is what really sets this approach apart and to address the unique challenges of consulting income. Let me show you exactly how this works using our example of that $265,000 in your BRV after those first 10 years. It's a simple 3-step process that changes everything about how your money works for you. 1, you can access your money when you need it. You take out what's called an index loan for, let's say, $265,000. The loan interest rate is roughly about 3.2%. That's roughly $8,500 per year. Now, here's the game changer. Your money still grows inside the policy as if you never took it out. That original $265,000 continues growing at around 6.5%, generating about $17,000 annually in tax-free growth. Now, the bottom line, you're earning $17,000 a year while paying $8,500 in interest, and you're netting roughly $8,500 annually, all while you're using your $265,000 elsewhere. Think about that. This is the true magic of becoming your own bank. You get to use your money for whatever you need, covering expenses during contract gaps, investing in your business, or handling personal financial needs, while that same money continues growing inside the policy. Think about this real-life example. A 50-year-old consultant builds up $265,000 after 10 years. They can take out about $29,000 tax-free income per year, and their account grows to over $500,000 by age 70. And over their lifetime, that can amount to $1.7 million in tax-free income. This solves that impossible choice between growth and access. You're not just earning a return. You're creating a financial system that works for you through both active contract periods and those inevitable gaps. Now, let's compare the business retirement vault strategy to traditional 401k IRA approach, right? This is where the differences really become clear for professionals. Now, both approaches start with the same $250,000 over 10 years. That's the same money, right? But what happens next is dramatically different. After 10 years, the traditional approach shows about $360,000, which looks better at first glance. Now, the BRV shows $265,000, which seems smaller initially. But when we look at the income, the traditional approach gives you around $13,000 per year after taxes. The BRV gives you around $29,000 per year completely tax-free. That's more than double the income. And here's what happens over time. With the traditional approach, your account value decreases every year as you take withdrawals. With BRV, your account value actually increases to over $500,000 by age 70, even while you're taking income. And for consultants specifically, the traditional approach, you're exposed to market crashes, potentially during contract gaps or retirement. Now, the BRV approach, you have a zero loss protection regardless of market conditions. Your worst case scenario is your money doesn't go down. Now, when it comes to accessing your money, traditional approaches, you have limited access, you have penalties, required distributions, and it's all taxed. And if you believe taxes are going to be lower in the future, then this is not the right fit for you. But if you believe taxes are going to increase, then you should definitely stop tax deferring, because it's only going to get worse the more money that you have. Now, in the BRV approach, you have control. It's your money. Use it when contracts end or opportunities arise. And this is why professionals like yourself are diversifying into these strategies. Now, let me share a real quick example that shows the power of the strategy specifically for consultants. So my client, Karen, is a consultant who was completely focused on growing her business with almost no retirement planning. And she had some money in an IRA, but no real strategy for handling inconsistent income that came with her consulting work. Now, when we showed her how much of her retirement savings would be lost to taxes and how inaccessible her money would be during contract gaps, she was stunned. This was something her previous financial advisor had never explained to her. And we helped her implement the business retirement vault, and just 3 years later, it proved its value in a way that traditional accounts never could. When her son needed $7,000 to pay off his car during a period when she was at the end of one of her major contracts, she was able to borrow that money from her policy tax-free in less than a week. And that loan rate was just 3.2%. And remarkably, that $7,000 she borrowed continued growing inside her policy as if she never touched it. This gave her incredible peace of mind, knowing she could help her family without disrupting her long-term financial strategy. Now, she's now repaying that loan on her own terms with no fixed schedule while building significant tax-free wealth for her future. And most importantly, she's no longer stressed about contract gaps because she knows she has a financial foundation that works regardless of her consulting schedule. This is the Business Retirement Vault in action, providing both immediate liquidity when life happens and long-term financial security without compromise. So, to summarize what we covered today, the Business Retirement Vault delivers on all 3 L's of wealth and gives you a unique combination of benefits. So you get protection from market losses during contract gaps, you get competitive growth potential, historical averages 6 to 8%, tax-free growth and access, the ability to become your own bank, long-term tax-free income, liquidity when you need it most, and unlike traditional retirement accounts, this strategy gives you complete control over your money regardless of contract status. And you also get protection from market volatility, access to your capital when needed, and substantial tax advantages, and the ability to build generational wealth. Now, as promised at the beginning, everyone who attended today on the Zoom will receive a free copy of my Business Retirement Vault book. This comprehensive guide will include more detailed information about everything we've discussed today. Now, plus it'll give you some additional examples on how our clients are using this strategy and help you navigate unique challenges of variable income. Now, to claim your free book, just simply put in the chat free book if you're on the Zoom, and my assistant is going to log everything, and then we will text that to you, the link for you to download. Now, for those on line, we're going to post a link to buy the book. It will be heavily discounted. It will be only $9.99 for if you take action between now and Sunday. So now you understand how the Business Retirement Vault works for professionals like yourself. Let me share why scheduling a strategy session today is critical if this approach interests you. The reality is, people miss is that the qualifications for the strategy is not guaranteed. I've had clients recently who were excited about implementing this approach, and he scheduled our strategy session but decided to postpone on finalizing things, and because of some routine medical appointments, unfortunately he found out that he had cancer, and he became instantly unapprovable for this product. Now, despite his financial qualification and genuine interest, he became instantly uninsurable for the strategy, and this isn't uncommon. The companies backing these policies are highly selective. It's precisely why they can offer guaranteed protection we've discussed. Their strict underwriting standards are why you'll never lose money due to market performance. Now, beyond the health considerations, there's also the hidden cost of waiting. For every $100,000 sitting idle in low interest accounts, you're potentially leaving $6,000 to $15,000 on the table. And that compounds year after year. And that's money that can never be recovered. So if you're interested in seeing how this could work for your specific situation, your next step is scheduling a complimentary strategy session. And during this personalized consultation, we'll analyze your current financial setup and identify optimization opportunities, determine if you meet qualification criteria for the strategy, and create a custom structure that maximizes your specific situation. And we're going to show you exactly how the numbers could work for you and your goals. And we'll give you a clear, honest assessment, even if it means telling you this isn't the right fit. Now, what makes this different from typical financial consultations is that I'm not looking to simply sell products here. As I mentioned earlier, I deliberately maintain a small client base because proper implementation requires ongoing guidance and customization. And each structure needs to be precisely calibrated to avoid just becoming another underperforming policy. So, due to the depths of the analysis and customization involved, I only have a few consultation slots over the next 2 weeks. These are allocated on a first come, first served basis. Now, to reserve your complimentary strategy session, you can go to businessretirementvault.com/book now. Again, that's businessretirementvault.com/book now. Or you can text to my number, BRV, to 321-282-6801. Again, that's 321-282-6801. And you'll be able to select a convenient time for us to connect. Now, remember, if you're ultimately decided this strategy isn't for you, you'll walk away with clarity about your options and specific recommendations for your situation. And the consultation itself delivers value regardless of what you decide. At least you'll have a direction on what path you should go. So, thank you for joining me today. I hope this presentation is giving you valuable insights into a different approach. Now, I'd like to open the floor for questions. This is your opportunity to get clarity on anything we've discussed today or ask about how the Business Retirement Vault might apply to your specific situation as consultant. But I want to start off by answering some of the common questions I get most often from clients. Now, while I'm going through these, please feel free to type any other questions into the chat. I'll keep an eye on the chat and address as many of your individual questions as I can in the next few minutes. Okay? So let's start with the first common question. How is this different from like a Roth IRA or a 401k or like another tax account? So, unlike 401ks, Roth IRAs, right, there's no age restriction of 59 and a half to access this. And there's no 5-year waiting period to access your money. You have complete flexibility and control on it with no contribution limits while still enjoying tax-free growth and distributions. And this gives you access during like contract gaps or time and without penalties. Now, this is once it's fully funded, which we will get to in the call itself. Now, here's another question I hear very often. What are the health requirements? Well, requirements vary by company, but here's what's important. Our strategy does not focus on maximum insurance. We focus on cash value growth, not maximum insurance. So we developed approaches that work for most health situations, even if you're not in perfect health. So we can typically find a solution that delivers returns similar to what you are expecting in meeting your goals. People always ask, how quickly can I access my money? So this is important. We can structure your plan for accessibility in the first year if needed. 30 days after the first payment, right? Or we could design it for longer term growth. Like any financial vehicle, allowing time for growth is ideal, but we customize the accessibility timeline based on your specific cash flow needs. But just remember, just like anything else, if you want your money to grow, you need to give it time to compound. All right, so here's another important consideration that people ask me. What happens if I can't make payments during a period of time? So this is exactly why we create flexible plans. We strategically structure them to accommodate variable income patterns of consulting or business, and your plan can be designed with the built-in flexibility to handle those inevitable contract gaps or slowdowns in your income without derailing your whole long-term strategy. Now, on to the next question. A lot of business models have like their own intricacies. So the question I get is like, how customizable is this for my situation or your business? Complete customization is the cornerstone of our approach. Every plan is built specifically for your unique situation, your contract cycles and goals. And this level of customization is why we limit the number of clients we work with each year. These aren't off-the-shelf solutions. So just remember that. These are personalized. And in this day and age, there's a lot of things you don't get personalized. But you definitely want your finances personalized to your situation. Now, what are the tax implications of policy loans? So policy loans remain tax-free as long as the policy stays in force. So we carefully structure a plan to avoid creating what's called a MEC, or modified endowment contract, which would change the tax treatment. And this ensures your access to funds maintains its tax-free status. Next, people ask is, how does it work for the money? Like, does it increase with the index, or how does that work? Like, how you're protected? So your money is tied to an index account with a contractual floor of 0. So what that means is that your money is not directly invested in the market. They give you a credit based on how the market does each and every year. So it's on a year-to-year basis. So if the market goes up, you participate in those gains. If the market goes down, your principal remains intact. Now, this creates steady, consistent growth over time without the setbacks of market losses. And kind of last question I hear is like, what happens if the tax laws change? So life insurance taxation has remained unchanged since World War II. So because these policies are legally defined as life insurance, not investments, they operate under a different section of the tax code. The death benefit structure ensures they maintain their tax advantages despite changing political environments. Now, I've addressed those common questions, and I want to transition to the chat to address as many of your individual questions as I can in the next couple minutes. But let me take a quick look to see what's coming in. And if you have not, please put your questions in the chat. All right, and then we have a couple questions. So is there any kind of limit or a cap to how much you can borrow from it, like per year or just in general? Now, there are limitations based on how much you put into the policy, right? So there's not a magic thing that you can borrow random money from, right? You're not just getting a loan. You're getting a loan on your own money, and they're allowing that money to continue growing. So however much you have in accessible cash value at that time, that is what you're able to borrow against, just to clarify. Now, other people ask me, oh, what if I want to borrow it all? Okay, you absolutely can, right? But keep in mind, right? If you're just borrowing it to put it into a bank account that doesn't get interest, there isn't a point in doing that. You should be focused on getting more interest or using it for something that's either benefiting you, as in, hey, I need this to live, or you're trying to enhance your life. All right, next question. So people ask, how much does this cost? What are the fees? So here's the beautiful thing about this. So this is what's defined as a max funded index universal life policy. So max funded means that we buy the minimum legal amount of insurance that we can, and we put in the most amount of money we can legally under the tax code, TEFRA, DEFRA, and TAMRA. And what that does for us is that allows our money to grow and build tax-free without any market loss. But the key here is that the cost that you have is just the cost of insurance, which is easily cheaper than taxes. Now, keep this in mind. When we get that minimum amount of insurance that we legally can, your cost for the insurance decreases the longer you have the plan. And so we'll get through those advanced concepts later, but that is your cost, is having the life insurance contract itself. But if you think about it like this, right? If you had, let's just say, a $500,000 life insurance policy separate, this is like having a $500,000 life insurance policy separate, but you have money on top of it growing tax-free. So if that makes sense. Now, I have time for probably like one or two more questions. Let me see what else is in this chat. So another question from our viewer. How hard is it to get approved in terms of health? Okay, so I kind of addressed this one already, but that's fine. So in the health side of things, you can't have any major issues in terms of like things of terminal illness. Okay. Now, even if you have some health issues that you are kind of questioning, it's always better to ask and for us to figure out if it's going to be disqualifying. Because I've had clients who have diabetes or pretty bad that thought they weren't going to get approved, and we got them approved. And we got them the same rate and the same type of returns that someone who had perfect health had. All because we're legally, which is another thing, the government doesn't allow discrimination when it comes to this strategy. So as long as you are insurable, keyword, insurable, you have to be insurable under whatever the company's parameters are. But as long as you're insurable, someone that is at the lowest rating and someone who has the best rating, they have to have the same opportunities according to the government when it comes to the index side of things. So if you get a lower rating, we're legally allowed to decrease the insurance even further to offset it. So that way you would just be paying the same amount of cost as someone that has perfect insurance or perfect health, which we can get to in another strategy session. But yeah, that's a little bit more advanced topics, but that's all I have for right now. So I want to thank you guys for being on the call and on the webinar. You guys have a blessed rest of your day. And don't forget, you can click on the link and you can book now. But if you think of any additional questions, also too, you can text us at 321-282-6801. And if you want to schedule a strategy session, go to businessretirementvault.com/book now or text me BRV there. Thank you again for your time. And don't forget to claim your free book if you haven't already on the Zoom link. I will put the book as an attachment to the video. Talk soon.